you do wonder if, yeah, it's just another reason to just hold fire on any increases next week. And, we're probably going to see more and more evidence that, there's no rush to do this, hold fire, and we'll wait and see what happens over the next few weeks following that. Kia ora, and welcome to New Zealand Property Market Podcast, brought to you by Cotality for the 29th of June 2026. I'm Head of Research Nick Goodall, and I'm joined today, as per usual, by our Chief Economist, Kelvin Davidson. Kelvin, let's get straight into it today with a quick look at the New Zealand Activity Index, the NZAC, for May. Are things holding up okay? What's the sort of latest read on it? And I know it's only 2 months of the quarter for Q2, but how's it sort of shaping up the maybe official Q2 GDP numbers, Kelvin?
Yeah, so this is New Zealand Activity Index, monthly indicator. It's meant to be a sort of timely proxy, I guess, for the benchmark quarterly GDP numbers, which are obviously quite lagged. So this composite index takes into account sort of 7 or 8 underlying variables. I think like traffic movements are in there, and some jobs numbers, confidence figures. So it's kind of across a range of different indicators. I think it was brought in during COVID actually to be a sort of real timely indicator on what was happening when the world was going crazy. So yeah, sort of a time, and it's got a pretty good track record, I think, of being mapped onto GDP. So it's definitely worth watching. 2% up in the year to May. That was the same figure as April. Now, not terrible. I mean, 2%. It's kind of middle of the road for as historical comparisons go, but it has slowed a bit from where it was late last year and early this year. It was up at sort of 2.5% at least, pushing 3% some months. So it has slowed. As I say, it's not terrible, but it has slowed. And so I guess that's as you'd expect, given everything that's been going on in March, April, May. So yeah, it's kind of middle of the road, I suppose, is a good way of putting it. Probably. I mean, didn't necessarily have much expectation for it really, but it's maybe held up a little bit better than what I would have thought. Probably consistent with some other economic indicators, not all of them. So some of them have definitely collapsed, but yeah, there's kind of this contrasting views at the moment. In terms of quarterly GDP, you can sort of do some fiddling behind the scenes and kind of map it onto what it might mean for quarterly GDP change. The NZAC is an annual measure, so you've got to sort of run a few different calculations, but yeah, it's possibly indicating GDP down about 1% in the second quarter. Now, again, that's only April, May, and I think it's probably overstating things. I don't think it'll be as bad as that, but I think it just goes to show that that some of the indicators that feed into that have been pretty weak, and I think probably that's reflecting the confidence numbers. I think it takes into account business confidence from ANZ, and that has fallen a long way. So, I mean, either way, I don't think GDP in Q2 will be down 1% based on sort of, what's happened with the peace deal and that sort of thing. But it does show this caution out there. And there are other indicators, you can look at, say, the Bank Economist forecast for Q2 GDP, the RBNZ Kiwi GDP number, their Nowcast, as they call it. Those numbers are suggesting it might be sort of around zero, slightly negative. I think ANZ's got a minus 0.2%. So, I think the NZAC is probably understating things or exaggerating the scale of the downturn in Q2, but it's still pointing to that caution, and those other indicators are still looking pretty cautious too. So after a decent Q1 number for GDP, it looks like we've definitely got that slowdown in Q2 as you'd expect. So yeah, it's probably not terrible, but it does show we've slowed as you'd expect.
Yeah, so I mean, I suppose following up from recent chats about the economy again, and I suppose that Q1 data which we saw was 0.8% increase, lower than many expected. So again, it probably just shows that yes, this economy is struggling. Q2 is going to look difficult. It is probably pretty hard to estimate exactly where it's going to land, given all the disruption from the Strait of Hormuz being closed for all of that period too. So I suppose there's going to be some lag to understand exactly the impact that's happened in Q2. So we won't get those official figures for another 3 months, I guess. I do wonder, I don't know if you've gone through the exercise of comparing what goes into NZAC and what goes into that Kiwi GDP nowcast from the Reserve Bank, because I wonder if we're almost better to go NZAC was good, as you say, in COVID times, but the nowcast seems to take into account more things. It's updated more regularly. And I did have a quick look in the last couple of days at that nowcast, and you're right, it's around about 0%. You can see it change over time. Basically every week they change their estimation based on all the information that's come to them. you do see these big spikes when the surveys come out. So the survey data does feed into it as well. And when the survey comes in, it seems to spike one way or the other for what their expectation for the quarter is going to be. So I wonder if it's a bit better at smoothing that out over time. Initially, it uses it and over exaggerates the result. But I wonder if the NZAC might be reducing in its relevance now Kiwi GDP Nowcast is there, because it seems to take into account most of the same stuff that the NZAC does, but takes into account more, gives it more regularly, and I suppose we'll need to do a bit more work in tracking it to see if it's more accurate. But as I said, it's closer to 0%. So and that feels about right to me. So I wonder if it's time to switch there. And again, just shows the economy is struggling right now. And if we're going to continue to weave everything into a conversation around how's the Reserve Bank going to read this, you do wonder if it's just another reason to just hold fire on any increases next week. And we'll talk shortly about maybe the last round of data they're going to see in the next week or so before that decision. But I think we're probably going to see more and more evidence that there's no rush to do this. Hold fire, and we'll wait and see what happens over the next few weeks following that. But so I don't know if you've got anything more on the economy. Otherwise, Kelvin, the other release out last week, which is probably worth noting, but pretty briefly, is the mortgage lending data from the Reserve Bank for May. I suppose, again, there's probably not too much new or different insight to be taken from the data. It does follow on from the conversation we generally have about buyers, in terms of who's doing the borrowing from the Reserve Bank data, but also who's buying from the data that we create from the buy classification series of first-time buyers to investors. So, anything you want to jump in from the lending side, anything you want to close out from the economy before we look at the chart pack that we released last week?
Yeah, just on the economy, and you're right, Kiwi GDP is much broader, and I think probably the thing that sticks in my mind is that it takes into account sort of the external sector. So it's taking into account, your imports and exports as well, which I'm not sure, probably indirectly the NZAC does, but it's quite explicit in that Kiwi GDP one on the Reserve Bank website. So it's I guess we'll feed them all into the mix, but certainly that Kiwi GDP number is broader. And just as a bit of background, it's the Reserve Bank's pretty clear to say it's not their only model of this is not the only way they think about the economy. It's apparently they have a whole suite of sort of ways of measuring the economy and forecasting models, that sort of thing, and it's just one of those that for whatever reason they decided to put up on the website. So it's one way that the Reserve Bank thinks about the economy, not the only way, but it's definitely worth looking at, and you can update it, you can see it weekly, so and see how those things change. And just I mean, we might come back to interest rates, but it's interesting that I think Westpac and somebody else last week, maybe ASB, pulled back from their July OCR increases and said, let's just wait till September. I might be lumping ASB in there incorrectly, but certainly Westpac did. So there's the mood's changed. I think an OCR increase is still sort of priced in the markets, but the mood's definitely changing. And I've got to say, I've probably changed my mind too. It just feels like there's not necessarily any rush now, provided that the peace deal sort of lasts. I mean, gee, that's a changing thing day today, but it does feel like that pressure might have come off a little bit, and particularly like we talked about last week or the week before with the structure of the votes. You've got to get someone to jump ship to actually get this OCR increase through. If everyone just sits where they are, three apiece, presumably that means another hold. So we might come back to that, but interesting sort of developments in the last sort of week. On the lending data, it was, noteworthy, I guess, in the sense that mortgage lending has slowed, as you'd expect, because we've seen sales volumes slow, and that's going to be tied up with mortgage lending. So there was 8.6 billion of new lending in May, which was actually the same as May last year. That's the first time that we haven't seen year-on-year growth in lending volumes since June 24. So we've had a good solid 2 years of year-on-year lending growth. This May, that we actually got no growth. So that slowdown's come through. We've seen that in property sales volumes too, so no great surprises there. It's all the breakdowns. I love this data set. There's so many breakdowns of LVRs, DTIs, all of that sort of stuff. It's just really trending sideways. Interest-only lending isn't really sort of going too far in either direction. The LVRs are still under control. Debt-to-income ratio restrictions are sort of not doing anything. We're under the speed limit. bank switching. There's still a bit of that going on, but it's definitely down from the spike we saw at the tail end of last year. So yeah, things are just sort of trending sideways really in that mortgage market. Still a lot of activity, but the growth isn't there as much as it used to be. Probably the thing that always stands out for me is just looking at first home buyers. Matches up with our sort of buyer classification figures. First home buyers still keen on those low deposit loans or high LVR finance. That first home buyers take out roughly about 70% of all low equity loans that go out. So they're really, really big on that finance at less than 20% deposit. And put another way, 53% of first home buyers in May took out a low deposit loan. So it's still more than half of first home buyers are getting in without 20%. We talk about it all the time. It's a pretty strong way in for first home buyers at the moment. So yeah, overall the lending numbers have slowed. Those breakdowns aren't probably telling us too much at the moment, but yeah, first home buyers still really taking advantage.
Yeah, which, as I say, sort of backs up the conversation we had a couple of weeks ago around buy classification, backs up what you spoke about in the release of the chart pack last week. So, yeah, maybe worthwhile just touching on the slightly different tweak you put on the numbers last week. We actually looked at the raw number of sales to each buyer group and how that's changed so far this year compared to the same period last year, because I think that was pretty intriguing numbers. Do you want to run through that from the chart pack release, Kelvin?
Yeah, so in our buy classification charts and in general discussion, we tend to look at market share because it's how these groups are interacting with each other and moving within the overall picture. But underpinning that, of course, is a number of deals, and sometimes it's easy if you focus on one thing or the other. I guess it's easy to sort of lose track of that a little bit. So I thought, we talk about market share all the time. Let's just look at the number of deals, and it's interesting that first home buyers not only have increased their market share this year, but they've actually done more deals. So in a market where the overall number of transactions from January to May is down about 5% compared to the same period last year, first home buyers have actually increased their number of transactions. So there's more first home buyers in market share terms, but also number of deals. So either way you cut it, first home buyers are faring pretty well at the moment. On the flip side, that we have seen that market share go down for mortgage multiple property owners and movers, and of course that's reflective of just doing fewer deals as well. So, first 5 months of the year, we've seen movers drop about 11% in terms of number of transactions compared to this time last year, and mortgaged multiple property owners down about 6%. So yeah, first home buyers really, they're standing out in market share terms, but they're standing out a number of deals too. They've actually risen in an overall market that's fallen, whereas movers and mortgage multiple property owners have seen their deals go down. So yeah, still caution from movers, still caution from those mortgaged MPOs, mortgaged investors. I saw an article this morning on Stuff just around the things that those investors might be concerned about. Is it taxes? I think the election probably is coming onto the agenda for some of those investors, and concerned about capital gains tax, for example, but also just that interest deductibility thing still sort of circulating around there in the background. People definitely got that on their minds too. So yeah, first home buyers really bucking the trend is the key point, and we've seen that number of deals for those other groups go down.
Yeah, I think it's really interesting, and yeah, totally agree about the investor mindset right now. The wariness they might have, especially about interest cost deductibility being taken away again, and I think it's part of the Green Party's proposal for tax changes. And speaking to someone directly last week, they were sort of saying, yeah, and Labor haven't ruled it out. So yes, they might be campaigning on capital gains tax, but as far as they were concerned, as long as Labor and Chris Hipkins keeps talking about this landlord tax break that National have brought in, or the current government have brought in, they think that is basically a way of saying, the interest cost deductibility is a way of, supporting landlords, and that Labor would want to take that away. As long as they keep using that terminology, they think that that's a potential. So, and I suppose that kind of makes sense in terms of, Labor haven't ruled it out. If they're going to continue to talk about them being landlord tax cuts, then I suppose that does show that they want to change them. And the Green Party have them as one of their policies. Then it would seem like, yeah, if you did get a coalition between at least those two parties, that would be something that would be reintroduced, which is probably a change in where I was thinking even 2 weeks ago, where prior to the Greens mentioning it, I still thought it hadn't been talked about by anybody. other than, yeah, as landlord tax breaks, which is an interesting way of putting it. So yeah, it just has started to change my mind as to the possibility of it coming back. I thought it was, an unlikely policy to come back, and it's not the sort of thing you want to be bringing in and taking away and bringing in and taking away. But maybe, the reality is, one side of the political leanings think one way, and the other side think the other, and they do see it as a way to, I don't know whether you're saying balance the taxes, balance the fair nature of taxes. I don't know which way you want to call that one, but it does feel like maybe it is one that's still on the card. So yeah, probably my mind changed in the last couple of weeks. And yeah, well, I suppose we'll just wait and see how things pan out as we move closer to that November election date. Otherwise, another thing I want to talk about on the chart pack, Kelvin, and we do this probably very infrequently, but worthwhile just pausing for a moment to look at the asset class data, which we have right at the front of the chart pack, which just shows the value of like residential properties, the value of money that's in superannuation and other stocks and commercial property, and partly to look at, I think, the overall loan to value ratio of all property in New Zealand, or all mortgages in New Zealand. And when you look at the total value of all properties, which is a figure we calculate, it looks like, for residential property, it's worth $1.67 trillion right now. Sounds like a pretty crazy high number, and it is. And of course, it shows that, our residential property is worth much more than any other type of asset class in the country. But when you look at the outstanding debt on all those residential properties, it's $398 billion. So that's across the country. So that really gives an LVR nationwide on all residential property of about 24%. So around about a quarter. Now, when you think about the fact that, first-time buyers are getting in with more than 80%, it does show just how much equity is sitting out there, right? Now, I'm not saying everyone needs to go and draw on that, but I suppose, that does illustrate why we have so many different organizations and people out there that are set up to say, you've got all this equity, do something with it. There's no real other asset that you can leverage against than residential property in particular. And I think it shows why so many people are out there saying, did you know if you could leverage on your property, you can go and use it to buy another property, and that's typically the way that things have been done. And I think it's really relevant right now because we are seeing more and more articles and commentary out there that talk about expecting less capital growth in the future. And that's important, especially when you say, even right now, if you do leverage your current asset and you use that money to buy another property, an investment property, which you will obviously still need some lending on, it's still hard to make that cash flow stack up, right? Like we know the cost to own that property, the mortgage is going to cost you, all the other costs that it takes to be a landlord and manage that property. It's really hard to get that returning in rent. And we're seeing that in yield reducing, and and we're seeing that with activity, I think, reducing now, where it's hard to make that stack up on a cash flow basis. So then you say, well, people need to be investing for the long term, expecting some capital growth over time, which means that then you pay down that asset if you're going on not just interest only payments. And so you're building up some more equity over time by owning multiple assets and paying down the mortgages over time. But if that capital growth rate is reducing, we've been talking about this for at least 18 months, if not longer, where we're setting expectation of capital growth around about 3 or 4%, not 6 or 7%, not prices doubling every 7 to 10 years, then it is starting to change that mentality of, would I buy a property even if I can leverage on it? And it does feel like that mindset is changing. And maybe it's a generational thing as well. People got access to other asset classes. Now you can get in using the likes of Sharesies and Hatch and I don't know, Tiger, Hub and Wealth, those sort of things now are coming to the fore, Tiger Broker, where people can, don't necessarily see property as their only investment asset to buy in. And I just think it's a changing mindset that's worthwhile acknowledging. And it's come up in a few more conversations recently, whether it's, out there talking to people or even internal conversations and people sending me those articles of, people writing, are we going to see less capital growth over a longer period of time? And as I said, we've been talking about it for a while, so I think we should set that expectation. Does that mean property investment's not going to be worthwhile? I'm sure it'll still work for many people. We still need it to work for many people. We need to see people encouraged to build new properties, which hopefully longer term mean it costs them less to maintain and look after. So there's still some value in that because we need to continue to build properties for investors too, to offer to the rental market, for our growing population, for young people who want to be, renting a property and don't want to own because they're more transient in the way they want to live. And so we still need that to exist because we do have a growing population right now, and we will in the future, if things continue the way they have in the past too. So look, it brings a broader conversation around investor markets and investor property. And look, we could probably go on forever, but it's an interesting conversation anyway. So I just wanted to throw that in there, those figures in particular, to illustrate the situation, and maybe it sparks some conversation with the listeners as well. But yeah, I don't know if there's anything you want to add to that, or any further insight you want to offer up, or even questions you might have to the market as well, to see what people are thinking out there, because it does feel like we're going through a bit of a change anyway, and that data sort of shows some of the stats around it.
Yeah, for sure. Yeah, I mean that's a vibe that I'm getting all the time now too, and I mean I'm it's just always in the back of my mind. I'm always conscious of saying this time is different, because sometimes it's not, and is there a sort of mindset at the moment that people have seen house prices flat for a long time, and so they just sort of go, oh, extrapolate that out forever. Then if and when prices rise again, they're like, oh no, 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 I was wrong back then. This time isn't different. But I genuinely feel it is. I mean, if you look at some of those things that have driven up house prices historically, it just can't continue. So yeah, and I think that mindset is permeating out a little bit as well. And like you say, it could be an older generation maybe. The introduction of online share trading, all of that stuff. So yeah, I'm conscious of saying this time is different. Sometimes it's not, but it does feel like some of those fundamentals are there for it this time. So, if we're going to change the attitudes, now seems as good a time as any. I mean, all that aggregate LVR you talked about being down at sort of 24%. There's a lot of equity out there. I mean, it brings in things like reverse mortgages, for example. I see more and more about those becoming more popular amongst an older generation of property owning people who have built up equity, maybe don't have a lot of cash flow. So thinking about reverse mortgages. But also, I guess it brings in a sort of concentration of debt point. And I guess I'd just say that, yeah, there's a lot of equity out there, and in relation to the overall stock of property, it's relatively low. But for those people that have debt, which is around about a third of households, it's hard to get exact figures on this, but about a third rent, about a third own property without a mortgage, and about a third own property with a mortgage, whether that's investment or owner occupied or whatever. So you've got a lot of equity out there, but you've also got a concentration of people who hold all of the debt, and for those people, the burden of repaying that debt is quite significant. So yeah, there's a distribution thing here that comes in. And yeah, it's a fascinating topic. I mean, we could probably do a whole hour's podcast just talking about all of these issues around long run drivers, and how capital growth might look different in future and what it means. People buying different types of property. Do they have to think about more yield? Do they accept lower return because capital growth isn't there, or do they look to get the same return from different ways? Like, yeah, it's something I think about a lot actually. So yeah, interesting stuff. But long story short, yeah, there's a lot of equity out there, but also there's some debt concentrated amongst a relatively small number of households too.
Oh, that's a great point around that distribution. Yeah, so I think it's a really good point acknowledged. And yeah, I think it is a fascinating topic, and especially when you then consider that and say, well, so if you do have all these people of the baby boomer generation and age who maybe do have no mortgage on that property, what happens when they do move on, either wanting to sell or downsize or whatever it is, and they've got these massive houses, and do they transition that wealth to their children? Are they putting it to the rental market? And what are those people going to do with that once they do actually fully pass it on, and the ownership goes to the next generation of people? Are they going to sell it? Are they going to own a mortgage-free asset? Are they going to try and leverage against it? Like, that's a big question for that transition to, I don't know, whatever the next phase looks like. So yeah, as you say, big topic, not one for us to get too deep into today, but certainly hopefully stirs a few things in people's minds anyway. And yeah, hopefully, keen to hear from you out there if you've got any thoughts or questions on, what that could look like, and any experience you've got out there as well, and then thoughts as to what might happen as we go through that transition from generation to generation. But yeah, let's leave it there for now, Kelvin. Another thing I really want to talk about was what's upcoming this week. I know we've got the home value index for June, which will be out later in the week. On your travels, you'll have to write that one, I'm sure. But the other one as well is just a quick look ahead at a few of the last data releases before the Reserve Bank meets next Wednesday. I know we will we'll probably do a full preview of their decision next Monday. So we can hold fire with a full preview and decision about what we think they'll do. But just run us through the data which is coming out this week. And I just want to give one plug as well for the external webinar we did last week, which is for essentially anyone that signed up to Cotality updates. It is quarterly. It's the full sort of hour with the presentation and all the charts and everything. So it goes into a bit more detail. If you're interested in that and don't currently receive the invite to that, or get the summary afterwards, please do let me know and I can get you added to that one, either for future or even an update on the last one anyway. So yeah, that's the last plug for that, mate. Before we move into any sort of personal and sports chat, do you want to just run through the upcoming week and data and info?
Yeah. So I mean, they're probably not necessarily sort of tier one stats, I suppose, but interesting kind of timely indicators on the economy. So we've got filled jobs for May that's coming out, I think later today or Tuesday. We've got business and consumer confidence from ANZ and building consents for May as well. So yeah, I expect they'll probably sort of all be kind of middle of the road. I mean, filled job. The thing about filled jobs is that it's always going to be sort of lagging because the labour market does lag a wee bit. So it might still look okay, but maybe there's some weakness to come. I suppose that's the thing around that business and consumer confidence, and I mean they might be up for June, but it'll be starting from a very low level. They have fallen a long way. So there's sort of like what half dozen. Let's say six of one, half dozen of the other. And building consents, they have been rising, but you'd wonder if some point if they do kind of slow a bit. So I think there's sort of buts with all of those indicators, and they might look okay at face value, but there's possibly some underlying weakness there. So I think, yeah, I'd expect it won't necessarily influence the Reserve Bank too much, but if anything, they might be slightly towards that angle again of just holding fire on the OCR. So we'll see.
Yeah, unlikely game changers, as you say, but let's see how they come out. We'll summarise them and anything else that we see in the next week or so before next Wednesday's decision. But that'll do us for economic and property market chat for this week, Kelvin. Now, we have to talk about the weekend. We have to acknowledge the All Whites. Pretty gutting result, of course, on Saturday afternoon. I mean, maybe naively, I thought we were genuinely a chance, but I think the way it played out was, shouldn't be any surprise. Like, that's how good Belgium really are, and we probably should acknowledge that was always the likely outcome right from before the tournament and even prior to, maybe I certainly got carried away with myself there. And I think ultimately, when the All Whites look back at this one, I think they're going to mostly be disappointed in themselves for letting that first game slip where they drew 2-2 with Iran. They led twice. They had chances to win. They probably shouldn't have conceded at least one of those goals they did against them. That was really the chance to get the 3 points. And that might have led to them playing a bit differently, which maybe that would have been, I don't know, not as real for them to try and defend against the other two teams. But we've seen some lower rated teams score draws against higher rated teams when they set out to do as much. I think the All Whites, bless them, tried to play against all three teams and looked good in patches against all of them. But ultimately, we're never going to match it against a team like Belgium and even Egypt. Once Egypt turns it on that second half of the second game, they look too good. And maybe the All Whites went too much into their shell in that game anyway, trying to defend the lead. But yeah, just hard not to think what could have been if we had won that first game. And maybe that just changes the mentality and the plan for later on. And you never know, they could have been playing in a round of 32 game. But yeah, it is what it is. Look, some great performances. Just Eli man, that guy has definitely got some career ahead of him. I can see him signing for a decent team at a high level. I know he's playing in Scotland for Motherwell, which is, not the worst of all leagues and certainly not the worst of all teams. And he's been looked at by the bigger teams in Scotland, but this might get him a chance to, maybe even jump across to England. Who knows? But yeah, I'm sure he'll be fielding some offers, that's for sure. There's a few others as well. I think Sermon has certainly done himself no disservice. And even Stamenic in the midfield as well. And so there's a few others. Obviously, Wood looked amazing in that first game and couldn't quite get into the other game. So, yeah, don't know. I suppose that's it. Disappointed. But as I say, they certainly gave themselves a good account on many occasions and should be proud of their efforts. Just going to rue that opportunity in that first game, unfortunately.
Yeah, that's been my perspective. I'm definitely no expert on football. I'm a casual observer, but it puts some perspective on it. And we're a small country ranked way down, so to get to the World Cup in the first place is pretty decent, and then perform the way they did, and I mean, yeah, for the individuals involved, possibly some boost to their bank balances. That'll be happy. But then, of course, they if they can keep playing for the All Whites, bring that experience back, I guess like Chris Wood's done. So yeah, I don't know. I think, well, hopefully, like I say, no expert, but hopefully it's sort of, as time passes, it's viewed pretty positively, and decent performance, and maybe they played in the right spirit. So I don't know. That's my take anyway.
I think one of the commentators mentioned in the second game, one of the early games, was that we had 60 professional players around the world. Like, that's very few, right? Fully professional, 60. Like, it's pretty small. I'd say at the 2010 World Cup, it was probably less than 30. I wouldn't be surprised if that was right. So, if we're on that sort of trajectory, we're going to increase that size and pool of players. And and certainly those that are professional are meeting that higher quality when you look at the likes of Wood and Justin and a number of others who are in decent leagues around the world. So, good signs for the future. Can't complain there for sure. So, I suppose we can enjoy the rest of the World Cup now without having to worry about having that emotional stake, because, yes, it certainly took it out of me in some of those tighter games. But also, we don't have any time to dwell too much, mate. We've got the All Blacks back in action this week, and you're heading to the stadium as well. So you'll be looking forward to that trip, and AB's back in action. So, yeah, it feels like it always comes around pretty quick, but I'm looking forward to it.
Yeah. Oh, yeah. No, looking forward to the ABs on Saturday. So we'll see which team they put out. See who I don't actually know who France has sent. Is it full strength? No idea.
I don't think so.
But don't have to worry about the weather because I'll be under the roof, so that's good. But yeah, there's I mean, obviously the football was disappointing, but it was a pretty good weekend. There was heaps of different sport on. I mean, obviously the cricket in England, like, it must have been amazing overnight. The Warriors lost, but it was it was got to be one of the games of the season. So. Yep, some things went well, some things didn't, but just having sport on is great. So you're loving it.
Yeah, now that first session tonight for the next day of the test will certainly be a good one, because it looks like England are going for it. They're 4 down, but still got some decent batters to go. Pretty tough target. So yeah, that'll be an intriguing one, and may well be over in that first session, so you can get it before bedtime tonight. So we'll hang out for that one too. But all right, mate, we better leave it there. Just want to say thanks very much for your thoughts and insights as per usual, Kelvin. I love our catch-ups on Monday. Thank you very much for listening. Please do get in touch with any questions or feedback. Otherwise, that'll do us for today. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.